Hey guys, I'm Desi Arnaz, professional investor, and I want to welcome you guys to today's show. This is the Note Investing for Newbies show. Today we're going to be talking about how to prevent note investing rip off. Yeah, that's right. You can get ripped off as a note investor if you don't know what you're doing out there. So today I'm going to be helping you new guys or you newbies understand this is just one way, of course, you can be ripped off, but bad people look for ways to take advantage uh, of people anytime they can. So you can't always protect yourself, but there's some steps that you can take. And today I'm going to show you some of those steps, some of the things that I do to protect myself and make sure that I get what I'm bargaining for, right? So welcome to the Note Investing for Newbies show. I come on every Tuesday at 2:30 Pacific, 5:30 Eastern, and we talk about investing in mortgage notes. For those of you that don't know what mortgage notes are, I'll just tell you this briefly. Basically, a note is a promise to pay. Another way to think of it is an IOU, right? That's what a note is. And the notes that I'm talking about today are the notes that are backed by a mortgage. So basically, when a person buys a piece of real estate, they're going to sign two primary documents. One is called a mortgage, and one is called a promissory note. The promissory note says to the bank, the borrower signs a promissory note to the bank saying, we agree to pay you, let's say, $1,000 a month for the next 30 years, right? Whatever it is, right? So they sign that note, and then they sign another document called a mortgage, and that says, if I don't pay you back, you can take my house. So that's what a mortgage says. And then they give those two documents to the bank, and the bank gives them the money so that they can buy the house, and that's how houses get sold with mortgages. Now, what happens next is that the mortgage itself might be sold by that bank to a different lender, and that's where we come in. Again, I'm Desi Arnaz, professional investor, and for those of you that just got here, I just want to let you guys know today we will be talking about how to prevent yourself from being ripped off as a note investor, because there are things that people will do to try and take advantage of you if they feel that you don't necessarily know what you're doing. And so I just want to show you guys a few little tips and tricks that'll help you just kind of navigate the waters a little better, okay? So if you're joining me on Facebook today, I would ask you to do me a favor and like and share this on Facebook. Give me some of that Facebook love. Like to know who's on with me today. Hit me up in the chat. Let me know who you guys are, who's on with us right now. I would like to say hello to you guys and maybe give you a shout out. If you are watching me from YouTube, please hit that like button, and then also subscribe to my channel. Because I put out this kind of information and all kinds of free information to help you learn how to invest in mortgage notes, and also how to be the difference maker in your family so that you can help your family get out of, let's just say, financial struggles generation after generation. We talk about those types of things also as a part of our group. I am one of the co-founders of the Note Investor University. That's where we teach people how to invest in mortgage notes. Today, our show is brought to you by the Note Investor University. These are some of our students that, they just kind of wanted to share their experience with us. Donna and Michael say this program has changed our lives. We're on our fifth note, and we're selling our rental house so we can buy more. These guys are genuine. Yeah, we are genuine. We want to see you guys succeed, and we show you how to do it. And we teach you how to do it using other people's money. Okay, so there you go, guys. That's our sponsor. Who do we have on today? I'm checking the chat. Let's see what we got going. Let me know in the chat your name and maybe what city you're checking in from so that I can give you a quick shout out. My name is Desi Arnaz. I'm a professional investor. Been doing it now. Been investing since 1982. Probably longer than many of you have been alive, and I've been investing in mortgage notes now since 2013. So I'm in my 9th year of investing in mortgage notes, and I love it. Right? I won't go back to buying bricks and sticks anymore. I definitely prefer investing in mortgage notes. Okay. Also, if you guys decide that you want to invest in mortgage notes, I can teach you how to do it, and you can actually earn money while you learn. That's the type of program that I've structured so that you can earn, you can learn from me and from our staff, but yet at the same time, you're not just paying money to be educated. You're also earning money while you do it. So let's talk about how do you keep from getting ripped off. Well, I want you to understand that what happens in this business is there are people in the business that will try to tell you that a note is good. And one of the things that I'm going to suggest to you that you do is of course, you always want to conduct due diligence. But in addition to that, I'm going to suggest that you consider learning how to grade notes. And so I'm going to share with you how I grade notes. And hopefully this will help you to grade your own notes. And it's a form of due diligence. It's a part of that whole process. Although I know many people don't grade their notes, and I think that's a big mistake. That's my personal opinion. They should be grading their notes all the time before they put them up, before they close on a transaction. So what is grading notes? Well, if you go back to your school days, your university days, or whatever, you know that you got a grade along the way, right? An A, B, C, or D, or an F, right? And we have something similar in the note space. We have A, B, C, and D, and then we have non-performing assets. I guess you could call those are Fs. And I'm going to talk a little bit about all of that here over the next few minutes. But here are the things that I look at when I'm considering buying a note. This is how I grade my note. The risk factors that I look at. And you may want to write these down if you're thinking about investing in a note. Take out your little journal or your notepad. I hope you have a journal that you can refer back to periodically. I started journaling back in 1992 when I spent a day with Jim Rohn. If you guys know that name, he was a philosopher and a motivator. And he came to our company and he spoke to our entire organization. I was working for General Motors at the time. They had a mortgage division. I was working there. And he started talking about keeping a journal. And to this day, I have stacks of journals because everything I do, I'll just write it down in my journal. Phone conversations that I have, things I want to remember. Anyway, risk factors. Let's talk about risk factors. One of the things that we look at when you're in the money business, like I am, and like hopefully you'll be too, we look at the borrower's character. If someone wants to borrow money from you, you have to look at their character and say, do I trust this person? Do they seem trustworthy, right? Do they have good character? And one of the ways that you can kind of judge that is by going through their application. So we look at the borrower's character. If they've been floating around from job to job and every 6 months they're on another job, it's possible they got some issues, right? It's possible. So you want to ask more questions. You can also talk to people. You can interview them. You can also interview people that know them in order to try and determine their character. We also look at the collateral, the viability of the collateral. Now, remember I said earlier that a mortgage document gives the lender the right to take a piece of property from the borrower if they fail to pay, right? So that real estate is the collateral. And the question that you want to ask yourself is, if I have to foreclose on these people and I wind up owning that collateral, is it a viable investment for me? Do I even want it, right? Is it in the right neighborhood? Is it the type of real estate that I would want to own? Because you never know if people are going to pay you or not. You hope that they'll pay their mortgage payment, but if they stop, the collateral is what you have to fall back on. So you have to take a look at that. And we teach you guys how to ask the right questions and what questions to ask, and then how to analyze the collateral. But that's another thing that you'll do. Something else I like to look for is the equity that the borrower has in the property. Because the reality of it is this: if a person has a lot of equity in their real estate and their life goes sideways and they start running into financial troubles, they can always sell that real estate, pay the real estate agent fee, and still walk away with a lot of cash. That's equity. Now, if they don't have much equity in that real estate, if they sell the real estate, they won't walk away with any cash. And so they're far more likely to just give the house back to you as the lender to say, hey, you know what? You just take it, because they don't have any equity. So if they have good equity in that property, that's one way that you can know that you're getting a good asset. Okay. And so I look at that equity position. The way you calculate the equity is basically you say, what will that house sell for today? And how much do these people owe on the property? And as an example, maybe the property will sell for $100,000 and they owe $80,000 to the bank. So that means they have $20,000 in equity. That's a 20% equity position. And in the lending industry, 20% is kind of like the magic number, right? If they have 20% or more in equity, you're okay. In most cases, you're okay, right? The other thing that you want to do is examine the loan terms. These are the risk factors that we look at, right? Borrower's character, collateral viability, borrower's equity, the loan terms. What kind of terms are in this note? Is it a 30-year or 20-year? Are there prepayment penalties, late charges, anything like that, right? Is it a fixed rate or an adjustable rate? You want to look at all these things as you assess the risk, because you're going to use all this information in order to do something called loan grading. Okay? You're going to do loan grading, and I'll tell you how you're going to do that as we move forward today. We also, of course, look at the payment history. Is the borrower making their payments every month like they're supposed to? Maybe they are paying 12 payments a year, but are they paying it on time? Or do they pay late every month? Or do they skip some months and then make double payments the next month? Things like that, right? You want to look at that. And then, of course, you want to look at the quality of the paperwork. All of these factors will impact the risk that you're going to assume when you buy that mortgage. And so what I want to do is just talk with you about how to price your note. And this is how you protect yourself from being ripped off, right? Once you grade the note, then I can show you how to price that note and what to offer on that note so that you don't get ripped off. It's really that simple, okay? So here are the grades, and here's what you could expect. And you'll probably want to write these down, or at least take a picture of the screen as I go through these. Because if you want to know how to grade a note, this is where the market is right now. The market in the note business changes just like the market in the real estate business or the market in the stock business, right? Stocks, a share of Microsoft doesn't always sell for the exact same amount, right? It changes. Now it's very volatile, so that means it changes often. It could change many times in one day, and that's what it does. However, in the note space, our market does change, but it's not that volatile. It changes slowly and it changes over time. So it would take months and months for the numbers that I'm going to share with you today to actually change very much. Could even take years. It depends on what's happening. But a grade A note is a note that has very little risk. Now, getting back to what I talked about earlier, right? The borrower has good character. And one of the best ways to measure their character is, do they pay their bills on time? And do they hold on job? Can they hold down a job, right? Have they got a good savings habit? You can just look at their bank statements and you can see, do they save consistently? You can also look at their credit report to see if they pay their bills on time like they're supposed to. You can do things like that. So we teach you how to do that stuff. We look at these risk factors. If they have good character, if the collateral looks nice, it's a decent looking property, doesn't look like it's all run down. If they have equity, 20% or more is wonderful, right? If the terms are decent, maybe it's a fixed rate note as opposed to an adjustable rate note where the interest rate changes every year, right? That's kind of scary. And they make payments on time. And these people have been making payments on time for a period of time. Then at that point, you can say, I've got a pretty good note. And, assuming that the paperwork was done well, usually if it's done by a title company or an attorney, it's done right. So you look at that stuff. If some guy wrote up his own paperwork and then did a mortgage for someone, that's a whole different story. But you want to take a look at the quality of the paperwork. So here's what you'll see. If, in fact, that's an A-grade note, you decide that it's an A-grade note because they check all the boxes, right? If, in fact, that's what you believe, then that's a low-risk note for you. And the discount that you can receive on that note is going to be minimal. That's how it works, okay? The discount would be minimal. And what I mean by that is a discount is a reduction below the sale price, below the balance that you would pay. So for example, in the example that I said earlier, where the value of the real estate is $100,000. The balance owed to the bank is $80,000. Okay. You might get a discount of maybe 5% if this is an A grade note, right? And your yield, your return on investment, the money that you invest, you'll probably earn in today's market somewhere around 4 to 6% return on your money buying an A grade note. Because if you were to go to the bank right now, you're going to see that interest rates on like Fannie Mae, FHA, all these A grade paper, they're running in the 4 to 6% range today. Now that changes, as you guys know, but that's what you're buying. You're buying good paper like that. I don't buy A paper very often because I want higher yields. I don't want my money working at 4 to 6%. So I don't mind taking on a higher risk. But if you just want good cash flow coming in every month without having to worry about it, I would suggest looking at A paper. Okay. The odds are, though, you're going to be in the 4 to 6% ROI, return on investment range. That's the range you'll be in. Now, I do see some every now and then that might run 7.5, but that's kind of rare these days. I like to buy B grade and C grade notes. Now, B grade notes are also good notes, but they have some minor issues, right? Maybe on a B grade note, the people don't have 20% equity. They got great credit, they got good jobs, they pay their bills on time, but maybe they only put down 10% when they bought the house. So in the example that I've been using, instead of owing $80,000, maybe they owe $90,000 on a $100,000 house. So based on that, for me, I would call that a B grade note. Now, I know other people that would still call it an A grade note because they really put a lot more emphasis on credit, right? And people have great credit scores, they'll just give them an A grade. I look at the full package in grading these notes. But with a B grade note, you're going to get a bigger discount because there is more risk involved. And so the discount that you'll receive is anywhere from 5 to 10%. And you're also going to earn a higher return on your investment. Most of the B grade notes that I'm seeing come across my desk these days are paying between 6 and 8%, which is a really nice return. I like to see it this way. 8 is great, right? If you can get 8, that's great. 7 is heaven. So there you go. So I like B grade notes for that reason. A C grade note is a note that has moderate risk. And here's how I define moderate risk. I say a situation might look like this. Maybe these people, maybe they have decent credit, not super great, but it's okay, right? They pay their bills, but they pay slow all the time. So the payment is due on the 1st. They consistently pay on the 10th or the 20th. They're paying late charges every now and then. Every now and then they might even miss a payment, and then they make it up the next month, right? So they'll miss one payment, but the next month they pay 2. Those kind of people, at the end of the day, they pay their payment, but it's always a little iffy. I call those C grade notes, and I expect a deeper discount in those situations because these are the people that are more likely to have a problem, and we could wind up in foreclosure, right? And I could wind up owning a house that I don't want. Not that that's a bad thing financially speaking. It's just I don't buy mortgage notes to get the real estate. I buy mortgage notes to get the cash flow. I want the cash flow. And if I can get the cash flow, that's what turns me on, okay? And so I want these people to make their mortgage payments. Right? It's about the cash flow. I just want to welcome a couple of folks in here today. I see that my friend Gary, the truck driver, is in. Thank you, Gary, for checking in. Glad to see you here. Glad to see you here, buddy. If you guys want to hit me up in the chat, let me know who's here with me today. I see we've got in here. Let's see who we have. Ron in Maryland. Wow, the other side of the planet from me, right? Well, actually, the other side of the country, not quite the planet, but welcome, Ron. Glad to see you here today. I don't know if you guys are already in the note space, but I'm hoping that you'll find this grading instruction here helpful. All right. So let's get back to grading. The next level here, on the C grade notes, I would expect a 10 to 20% discount. That's what I look for. And I want to earn 8 to 10% on my money, if at least that, right? If I'm buying a C grade note. Now, when I first started investing in notes 9 years ago, C grade notes were paying 17 and 18%. A grade notes were paying 10, but things change, right? The market changes, as I said earlier. All right, let's look at a D grade note. A D grade note is a note that's going to have a higher level of risk. Okay, these are people that maybe out of the last 12 months, they only made, let's just say, 10 payments. They missed 2 payments, possibly 3, right? And they hardly ever pay on time. They struggle every month to make their mortgage payment. Those are D grade notes. And on those types of notes, I expect a much deeper discount. I expect to get a 20% or more off of the price of that note. And I expect that I will be earning a 10% plus return on the money that I put out there. All right, on the money that I put out there. Oh, I see that one of my partners just came on. Rodney, hey, Rodney. And you say, Ron, it's your son-in-law. Well, right on. Welcome, Ron. Glad to see you on today. Also glad to see you on too, Rodney. I'm glad you're here, buddy. Thanks for checking in. All right. So let's go on here and take a look at the next grade, which is the failing grade, if you want to call it that, the F, right? We don't really give it a grade except to call it non-performing. A non-performing note is a note where people have missed the last 3 mortgage payments or more. Okay? The last 3 mortgage payments or more. It's not a person necessarily that has missed 3 payments, because a person can miss 3 payments in a year, but it might be sporadic. They make 2 payments, then they miss 1, then they make 3 payments, and then they miss another one, that kind of thing. But if they miss 3 in a row, that's a non-performing note, and that's what we see in our industry. Now, a non-performing note, basically, that's a pre-foreclosure note. These people aren't making their payments. And I can tell you, most lenders at that point are starting to look and say, maybe what we want. And so that's what I do in these non-performing notes. But generally speaking, before I buy the non-performing note, I do try to find out if the homeowner, what happened in the homeowner's life, so that I can see if maybe when I own this note, maybe I can help these folks get back on track. Because as I said earlier, I don't really want the real estate. I just want the cash flow. I want them to make their mortgage payment. Okay. But if I'm buying a non-performing note, I expect a minimum of a 25% discount. Now, here's where some of you guys get tripped up, and I've seen it too many times. As a matter of fact, I even saw it very recently with one of our own students who came to me with a note he was considering buying. And that is this. You got a non-performing note like this. Let's just say these people owe $80,000. Let's say they owe $90,000 and the house is worth 100, but they're not making their payment, right? And the seller of the note says to you, hey, you know what? I'll sell you this note. I'll give you a 15% discount. Now, you know, I said I'd like to see 25% on non-performing. If you buy it at 15% discount, the seller will tell you, look, you're only going to be paying, let's see, 15% off of 80,000, right? So 10%, so was that 12,000 off? So you'll be paying $68,000 for that note. And he's going to tell you the house is worth 100. And so when you foreclose, you just take the house, you're going to make a whole bunch of money, make more than 30,000 bucks. Well, that's all well and good, but the thing that you need to understand is that there's never a guarantee that you can foreclose. These people could start making payments again, right? They may want to modify. And so, or they may fight you. They may file bankruptcy and cost you lots of money to fight them and finish your foreclosure. Those things happen. And so if you're going to be buying a non-performing note, you want to make sure you get a decent discount. Now, if the property is vacant and non-performing, that's a little different, because people don't fight to save a vacant house, right? They've already moved out. They've already moved on. Then I might consider a little smaller discount. I might do a 15 or a 20% discount off the loan balance. But for the most part, you want to stand firm at 25% or more. When I first got started investing in notes, we used to buy non-performing notes at 30% of the balance. So we were getting 70% discounts on these non-performing notes, but things have changed. The market changes. That's just the reality of all markets. They are not stagnant. They are volatile, and they do change. So those of you guys that just came on or who came on late, I just want to let you guys know that today's program is brought to you by the Note Investor University. And at the Note Investor University, we teach people how to invest in mortgage notes. That's what we do, right? And we help you get started. We even have a partnership program that you can take a look at if you're interested in getting started and you're a little nervous, right? We'll be in the deal with you. So we'll make sure you get a winner. That's what we do, okay? Because we're in the deal with you too. But, you know, I get good comments. Our students, we get good feedback from our students. They are progressing and building portfolios for themselves that literally will change their lives and the lives of their family members moving forward. So you can head on over to noteinvestoruniversity.com. You can learn more. If you're on Facebook, please like and share this. I would really appreciate it. And if you're on YouTube, subscribe to my channel. Okay, so let me just show you guys the next step. Once you've graded a note, the next step in the process is called pricing, right? Risk-based pricing. So here's how I'm doing these numbers. We're looking here, and you can see that we're looking at a property that's valued at $100,000. The balance is $80,000. If these people, based upon our personal risk assessment, if they are an A-grade note, I'd pay as much as $77,000 for that note, because the odds are they're just going to make their payment. I'm just going to get good cash flow coming in, okay? So I pay as much as $77,000 based upon that discount that we've been talking about. They owe 80, but I'd pay 77. If it's a B-grade note, then what I pay on this in this particular situation is probably $74,000, 73, 74, something like that for that note. Get a bigger discount because it does have some minor issues that, you know, concern me, but they're not big deals. That's why I don't take that much of a discount. Now, a C-grade note, I'd probably pay right around $68,000 for a C-grade note for this particular one if it were a C-grade note. Maybe a little more, probably 68. You know, I'd probably try to negotiate even a little bit better price than that. But that's the range, guys. There's no exact science on this stuff. It's just the range. And it really depends on you. Because first of all, you're the one that created the grade. You're the one who's going to grade it based upon your personal risk tolerance. What I call an A-grade note, you might not call an A. What I call a C-grade note, you might call it a D, or you might call it a B, right? So it just really depends on your personal risk tolerance. But if it's a C, then you can expect your discount to be 10 to 20% below the balance. In this case, the balance is $80,000, right? So 10 to 20% below the balance. I think I did this one at 15% below the balance. If it's a D-grade note, I absolutely expect to have a minimum of a 20% discount. 25 is even better, but certainly 20%. So I pay maybe $60,000 for that note if it's a D-grade note. Meaning, you know, these people pay pretty poorly. They have a pretty poor payment history. And, you know, you want to be careful with all this stuff. I did see a question on here from John Johnson. John Johnson asked a question. What if it's $25,000 worth of damage? I'm assuming that this question has to do with if you foreclose and you wind up with that property and you've overpaid for it. Yeah. If it's got $25,000 worth of damage, you could actually wind up losing money. So you want to be careful when you are buying these notes. You want to be careful and understand that you could wind up with the real estate. And if you realize that that property has a bunch of damage to it, again, that is going to impact your rating, your grading that you give this note. So John, if I knew going in that there was $25,000 damage to that property, then that, even if these people pay their mortgage payment every single month right on time, even if they got good credit, that issue is going to impact the grade. And there's no way that property with $25,000 worth of damage is ever going to be graded an A note in my book, right? Because A is a perfect note. It's not going to even be a B. It'll likely be a C grade note in my book. Okay, so that I would be looking for a deeper discount. And also, if it's a C grade note, assuming that they're paying their payments and everything, but the house needs work, if it's a C grade note, I'd be looking for closer to that 20% discount than the 10% discount, right? It's all subjective, but that's a good question. Thank you for asking, right? Now, if it were a non-performing note, and back to my example, if this were a non-performing note, oops, there we go. If this were a non-performing note, then I wouldn't pay more than about $55,000 for it, okay? That's about all I'd pay. But as I said earlier, some of these sellers, when they know that you're a rookie, they might come up to you and say, hey, look, you can pay $70,000 for this note because it's non-performing. The house is worth $100,000. There's $30,000 spread in there. By the time you pay your realtor, $6,000 and pay your attorney $2,000, you're going to walk away with a bunch of cash. But like John says, suppose there's work that needs to be done in the house. Maybe not $25,000, maybe $5,000, $10,000, whatever, right? Suppose there's some property taxes that these people did not pay that has to come out of your profits, right? You have to look at this stuff. And so that's why you want to push for the deeper discounts when you're looking at non-performing notes. I stand pretty firm on those deeper discounts when I'm looking at non-performing notes. But as I just said, these are all guidelines, guys. I mean, there's no hard and fast rule on how this stuff is supposed to work. These are all guidelines. And so what you'll need to do is just make a decision, what you want and what you're comfortable with. And then based upon what you want and what you're comfortable with, then, you can move forward from there. All right. So let's see what else we got on here. As I mentioned earlier, our training, our school, the Note Investor University, you can go to noteinvestoruniversity.com, and at noteinvestoruniversity.com, you can sign up to become one of our students, and we'll teach you how to earn while you learn. And you can also ask about our partnership program if you are new and you're concerned and you want to learn, but you don't want to take big risk. You can bring us into the deal with you, right? We'll partner with you in your first deal or two or whatever you want, right? You don't have to do that, but if you want to do that, just know that you'll have a pro in the deal with you, and you can learn while you earn. So that is my favorite way to do this, okay? And that's what I advise people to do, is to try and take advantage of the earn while you learn anytime you can, because most of the people that teach this business don't. Let me go back over here. Most of the people there we go. I can come back on camera. Yay, I'm back. I hate it when this technology freezes up on us. But there you go, guys. I just want to share that with you guys. If you're going to be out there looking at mortgage notes, learn how to grade them, because by using the grades, you'll know if you're overpaying and about to get ripped off. Okay, learn how to grade them. And if you are one of our students, literally, once you do your grading, you can bring it to me or to my partner Patrick. We'll look at it, we'll grade it without really judging what you did and see if you did it okay, and give you our own feedback on it too, so that you won't. We don't want you to step on a landmine. We don't want you to make a big mistake, and that's why we are more than happy to look over your shoulder and say, okay, do this, don't do that. We don't want you to be in harm's way. All right. So again, I want to thank you guys. Looks like we got some. Let's see. Did we lose audio? I don't know. Can you guys still hear me? Someone asked, did we lose audio? I don't know. On my side, it looks like audio is working. I can see my little audio meter still bouncing around. So I hope you guys were there. And I hope you found this useful and informative. Hit me up in the chat. Let me know. Did we lose audio? I don't know. Well, there we go, guys. I'm just going to wrap it up and call it a day. Again, I'm Desi Arnaz, professional investor. Thank you all so much. Head over to Note Investor University and get yourself signed up. Become one of our students, and let me help you earn while you learn. All right. God bless you all, and I'll see you all next Tuesday.